Okay, in this video, we're going to do a very basic overview of the accounting basics, so the mechanics behind how do we actually do accounting. First, we'll talk about the 4 types of accounts, right? Accounting involves using accounts to keep track of the operating performance and financial position of a company. And so we'll talk about the 4 types of accounts that we have in accounting: asset accounts, liability accounts, equity accounts, right? Those are all balance sheet accounts. And then we have a category called income statement accounts, okay? There are 4 types of accounts: asset, liability, equity, and income statement. And if you want to break up income statement further, I guess you could say that there are good things for the income statement, things that make net income go up, income, and things that make net income go down, expenses. And so we have income and expenses on the income statement, but I don't consider them separate categories. Okay, first we'll talk about the 4 types of accounts. Then we'll talk about how journal entries are able to affect the account balances. We'll talk about T accounts, which is how we track all of the journal entries that are affecting the accounts. And then we'll just go through the accounting process. So how does the process happen during the year? And we'll go through an example, okay? So first, let's start out with the types of accounts. First, balance sheet accounts. And there are 3 types of accounts on the balance sheet. And in fact, the balance sheet is separated into 3 sections: assets, liabilities, and equity. And when you observe a balance sheet, you are observing those account balances as of a point in time, okay? So assets as of a point in time, liabilities as of a point in time, and equity as of a point in time. And I've also included on here the definitions. So the basic definition of an asset. So it's much more complicated than this, but we can boil it down to the idea that an asset is some future economic benefit that will flow to the firm, okay? So it's a company, and some future economic benefit will flow to the company. That means it's an asset. If it's a liability, that means some future economic sacrifice. So it's the opposite of an asset. The company will have to incur some sacrifice in the future. Okay, that's the definition of a liability. And when you take assets minus liabilities, what you have is what's left, okay? And that's the equity, and it's typically referred to as what is the net worth. So if we take all of our economic benefits and subtract off all of our sacrifices, what is this company worth, okay? So that's the basic idea behind the 3 categories of balance sheet accounts. Income statement accounts, again, I've separated into 2 kind of subcategories: income and expenses. Income generally increases the net worth of a company, and expenses decrease the net worth of a company. And if you remember, income and expense accounts gets close to retained earnings at the end of each period, and so that's how they actually affect what's shown as net worth on the balance sheet. So now let's get more specific on these accounts, and I've just put some examples here. So here's some examples of asset accounts. Okay, so now these are all specific accounts. And so asset accounts, they have a normal debit balance. Okay, it's called debit. So we make asset accounts go up with a debit. And some examples of assets are cash, inventory, accounts receivable, and PP&E, which is called property, plant, and equipment. And all of those items relate to some future economic benefit of the firm. Now let's talk about liabilities. Liabilities are the opposite of assets, right? And their normal balance is a credit balance. So credit is the opposite of debit. So you increase a liability with a credit. And some examples of liability accounts are accounts payable, deferred revenue, and debt, okay? Finally, equity, remember, these are the net worth accounts. They're on the same side of the balance sheet as liabilities, and so you also increase equity accounts with credits. Some examples of equity accounts: common stock, additional paid-in capital, and retained earnings. And you increase these accounts with a credit, and you decrease them with a debit. Moving down to income statement accounts, income accounts like sales, other income, and gains. Okay, these are over a period of time, and their normal balance is a credit. So you increase sales with a credit. But let's stop here and have that make sense for us. Why would we increase sales with a credit? A lot of times when you first start accounting, that seems unnatural because assets are good things, right? And we increase them with a debit. Well, income is a good thing too. How can we increase it with a credit? It's because eventually these income accounts feed into retained earnings, okay? And so when we have income, it increases our net worth. And so these credits will end up increasing our equity, all right? And that's why income increases, sales, other income, and gains, those all increase with a credit. Expense accounts are the opposite. They increase with a debit. And some examples of expense accounts are cost of goods sold, depreciation expense, and other non-operating losses, okay? And again, these expenses decrease retained earnings. And so debits will decrease equity since you increase equity with a credit. Okay, now let's talk about journal entries. Journal entries are what we use to affect account balances, okay? Accounts wouldn't be able to have balances, or the balances wouldn't be able to change without journal entries, okay? That's the method we use to affect the account balances. We record journal entries under two scenarios. Either we record it because an economic event just occurred, and now we need to record a journal entry so that our financial statements reflect the event, or sometimes we record journal entries because we've arrived at the period end, and we need to adjust or close our accounts to make sure our income statement and balance sheets are fairly represented. Next, we'll talk about T accounts. T accounts is how we accumulate and track our journal entries. So T accounts have balances, and these balances are typically on the normal side of the account. And when I say normal, let's remember back to this sheet where I said what the normal balance for each of these categories was. Okay, so this would be the normal balance in the T account. So T accounts typically have a balance on the normal side of the account, and those journal entries that we just talked about on the previous slide are posted. It's called posted to these T accounts. And once they are, they can affect the balance. So if a T account has a debit balance and you post an additional debit, well, now it'll have a larger debit balance. If a T account has a debit balance and you post a journal entry with a credit, well, now that's going to reduce the debit balance of that T account. Now let's go through an example, okay? So let's talk about some journal entries. First, a general journal entry. So the reason we're going to record this journal entry is because an event is occurring. On July 1st, 2019, okay, we are in the New York Times, and we are going to sell a subscription to one customer. And that customer is going to pay us right now. They're going to pay us $120 right now, and we're going to give them a 1-year subscription to the New York Times. So it's going to last until mid-2020. That's how long the subscription lasts. What journal entry are we going to record because this event occurred? Well, usually I like to go about this by first asking myself, is cash involved? I always ask myself, is cash involved in this journal entry? The answer is yes. The company is receiving cash. Okay, cash is an asset account. Cash should be going up with this journal entry. And so how do we make an asset account go up? With a debit. So we're going to be debiting the cash account for $120. And the credit to this account, this is what takes a little bit of practice. Well, now we're asking ourselves, okay, this has to do with selling a subscription, but can we recognize this as revenue on the income statement? No, we haven't earned it yet. We need to defer this as deferred revenue. And so this is going to take some practice to get used to what account names to choose. But this journal entry is going to be a debit to cash, increasing the cash balance by $120, and a credit to a liability account called deferred revenue. And this is a liability, meaning it's a future economic sacrifice for New York Times. What's the sacrifice? Well, as of July 1st, 2019, the future sacrifice is I'm going to have to provide news to this customer for the next year, okay? And so that sacrifice has a value to it, and that is $120. That's why we record it as a liability as of today. Okay, great. Now what we're going to do, so that's the general journal entry. Now we're actually arriving at the end of our fiscal year. So suppose that's December 31st, 2019 is the end of our fiscal year. Now we want to create an income statement and balance sheet to show it to our investors. So we need to update this account for the passage of time. Well, 6 months have gone by, and so the customer has used half of their subscription, right? 6 months of 12 months subscription. And so we're actually going to transfer half of this amount into revenue. And that's called an adjusting journal entry. We're just truing up this balance sheet account and the income statement account so that they correctly state the operating performance and the financial position of our company. So we'll transfer half of that account balance out of deferred revenue. So we'll debit deferred revenue and credit revenue for half that account balance so that our income statement is going to reflect the $60 of earned revenue. Okay, we've earned half of this subscription, and our remaining liability now we only owe this person half of a year of news. Okay, so those are 2 journal entries. Now I'll show you the T accounts. Okay, here's the 4 T accounts we'll be dealing with in this exercise. First, what I've done is I've put beginning balances on the normal side of each account. So cash is an asset account. It's got a 0 there, beginning balance on the debit side because it's an asset. Deferred revenue is a liability account, so it's got a 0 on the credit side. Retained earnings is an equity account, so it's got its 0 beginning balance on the credit side. And revenue it's an income statement account, but typically we record credits to revenue, right? Because they increase the net worth of our company. And so I'm going to put its beginning balance on the normal side, which is the credit side of the revenue account. I'm just going to post now the first 2 journal entries that we made. The first one was we received cash, but we haven't earned it yet. So we received $120. That increases the cash account. I'm just posting this journal entry. And then we credited the deferred revenue account for $120, okay? The next thing we did was an adjusting journal entry, right? So we removed 60 from this deferred revenue account, and we put it as a credit in the revenue account on the income statement, okay? So those are the 2 journal entries posted to the T accounts, and now we're at the end of the year, so I'm going to just subtotal these accounts. I'll draw a line, and I'll subtotal all of these accounts. So our cash balance is sitting at $120. Our deferred revenue account is down to 60, and revenue on our income statement is $60. So after we've recorded this one adjusting entry, we're now ready to present our income statement to investors. So all we do is we go into our T accounts and just circle our income statement accounts. Usually we'd have more than one. This time we only have one. And now we just present it in an income statement. So here's the income statement, New York Times income statement for the year ended December 31st, 2019. We had revenue, that's the only account we had, of 60, and so therefore we have net income of 60. Okay, next step is now we need to do the closing entry because our balance sheet doesn't balance yet. So we need to close all of our income statement accounts to retained earnings, which is an equity account. And we do this at the end of each period. And so the closing entry for this company as of 12/31/2019, it's to ensure the balance sheet balances, and we're going to close out the revenue account. So it had a credit balance of 60. We're going to debit the account by 60. So the debit to revenue of 60 offset by a credit to retained earnings, the equity account of 60. And that's going to make retained earnings go up. So now let's post this closing journal entry to the accounts. We'll zero out the revenue account with its debit, and we'll credit the retained earnings account. And now we'll do our final post-closing subtotal, and that's ending balance and retained earnings of 60. Ending balance and revenue of 0 now. So now the income statement account is reset, and it's ready for a new fiscal year of activities, okay? So it's zeroed out at the beginning of each period. And now that retained earnings has that $60 balance, well, now our balance sheet is going to balance, right? We've got $120 in cash, $60 in deferred revenue, and $60 in equity. Assets equals liabilities plus equity. Now our balance sheet will balance. And now what we do, we just circle all of our balance sheet accounts. Okay, we've got 3 of them in this case, and we're ready to present our balance sheet. So here's the 12/31/2019 balance sheet of New York Times. The cash balance is 120, deferred revenue of 60, retained earnings of 60, and as you'll note, assets equals liabilities plus equity. So we've finished the entire accounting process for a year. So just to recap about the accounting process. First, we record general journal entries as transactions occur. Then we arrive at the end of a reporting period, and we decide, okay, now we need to report balance sheet and income statement to investors. So we record adjusting journal entries as necessary to make sure the income statement and balance sheet are fairly presented. And so, for example, we transfer some deferred revenue into revenue if we've earned it. Number 4, we report an income statement, so the income and expenses are reported on the income statement. Step 5, we close all of those income statement accounts into retained earnings. And step 6, we can report a balance sheet with assets equaling liabilities plus equity. And then everything, so the income statement accounts are cleared out. The balance sheet accounts are not cleared out, but they're as of the end of the year, so the point in time, the end of the year. And we are ready to go for the next year, and we start the process all over again, recording general journal entries for the following year. So this has just been an overview of the mechanics behind accounting.